Every dominant global currency in history has collapsed. Not most of them, every single one. And they all followed the same pattern. The Portuguese real controlled global trade for 8 decades, then vanished. The Dutch guilder ruled international finance for 80 years, then disappeared. The British pound dominated for over a century, then fell. Each one thought they were permanent. Each one was wrong. The US dollar became the world's reserve currency in 1944. That was 81 years ago. And right now, in 2025, the dollar is showing the exact same warning signs that appeared before every previous collapse. This isn't speculation. This is pattern recognition across 6 centuries of economic history. By the end of this video, you'll understand the 7 stages every reserve currency goes through, where the dollar sits in that cycle, and what it means for your financial future. Let's dive in. What is a reserve currency? Before we explore the pattern, you need to understand what a reserve currency actually is. It's not just a strong currency. It's the currency that other nations hold in their central banks. It's the currency used to price oil, gold, and other global commodities. It's the currency that international trade is conducted in. When you're the reserve currency, every country on Earth needs your money. They need it to buy oil. They need it to settle trade imbalances. They need it to hold safe assets. This creates what economists call exorbitant privilege. You can print money and export it to buy real goods from other countries. Meanwhile, other nations have to produce actual goods to earn your currency. You can run massive trade deficits year after year because foreign nations need to accumulate your currency for reserves. You can borrow at lower interest rates because global demand for your bonds is automatic, not optional. Being the reserve currency is the ultimate economic superpower. It's why empires fight to achieve it, and why they collapse when they lose it. Now, let me show you how that collapse happens. The 7-stage pattern. Throughout history, every reserve currency has moved through 7 distinct stages. These stages appear in the same order with the same characteristics, leading to the same outcome. Here they are. Stage 1, military dominance and trade route control. Stage 2, massive trade surplus and wealth accumulation. Stage 3, reserve currency status formalized, the peak. Stage 4, deficit spending and living beyond means. Stage 5, currency debasement through money printing. Stage 6, loss of confidence and search for alternatives. Stage 7, replacement and collapse. Let's go through each stage using real historical examples. As we do, you'll see exactly where the dollar fits in this pattern today. Stage 1, military dominance. Every reserve currency begins the same way, with overwhelming military power that controls global trade routes. Portugal in the 1450s achieved something revolutionary. They mastered ocean navigation while others were still sailing along coastlines. Portuguese ships rounded the Cape of Good Hope, opening a direct sea route to Asia that bypassed Ottoman-controlled land routes. But they didn't just discover these routes, they militarized them. Portuguese warships controlled the Indian Ocean, the South China Sea, and the Atlantic. They established armed fortresses at Goa, Malacca, Macau, and Mozambique. If you wanted Asian spices, you dealt with Portugal. If you wanted to trade with India, you needed Portuguese permission. This military control made the Portuguese real the currency that mattered. Merchants needed reals to conduct business in Portuguese-controlled waters. The Dutch in the 1600s followed the same playbook. The Dutch East India Company wasn't just a business, it was a military power with its own army and navy. At its peak, it commanded 40 warships and 20,000 soldiers. They conquered Portuguese trading posts, seized the Spice Islands, and made Amsterdam the center of global commerce. Britain in the 1800s perfected this model. The Royal Navy had more warships than the next 5 nations combined. Britain controlled the Suez Canal, Gibraltar, Singapore, and the Straits of Malacca, every critical choke point for global trade. The pound became the global currency because British naval power made it impossible to conduct international trade without it. The US achieved this same position after World War II. The US Navy dominates every ocean with 11 aircraft carrier battle groups, more than the rest of the world combined. America controls or has bases near every critical trade choke point: the Strait of Hormuz, Malacca, Suez, Panama, and Bab el-Mandeb. This isn't about defending America, it's about controlling global commerce, making it impossible for international trade to function without American approval. That's stage one. The dollar achieved this in 1945 and maintains it today. Stage 2. Trade surplus. Once you control the trade routes, you start accumulating massive wealth. Portugal in the 1500s bought spices, silk, and porcelain from Asia, then sold them in Europe for 10 times what they paid. The trade surplus was so enormous that Portuguese crown revenues from trade funded the entire government without heavy domestic taxation. The Dutch in the 1600s turned Amsterdam into the warehouse of the world. Goods from Asia, the Americas, and Africa all flowed through Dutch ports. They bought low in one market, sold high in another, and captured the spread. The Dutch trade surplus made Amsterdam's merchants richer than many European kings. Britain in the 1800s ran the largest trade surplus in history up to that point. They exported manufactured goods, textiles, steel, machinery to the world. They imported raw materials at prices set by British buyers. London's financial district handled more capital than the rest of Europe combined. The United States had the most dramatic trade surplus from 1945 to 1970. After World War II, America was the only major industrial power with intact infrastructure. The U.S. exported machinery, automobiles, and steel to a rebuilding world. The trade surplus was so large that dollars flooded into foreign central banks faster than they could be recycled. U.S. gold reserves swelled. Fort Knox held over 20,000 tons of gold by the 1950s, more than the rest of the world combined. This is stage 2, massive trade surpluses and the accumulation of global wealth. But here's where the pattern shifts. Stage 2 doesn't last forever. Eventually, the reserve currency nation moves from producing goods to consuming them, from exporting to importing, from running surpluses to running deficits, and that's when Stage 3 begins. Stage 3, formalization, the peak. At some point, the world formalizes what's already true. They officially adopt your currency as the reserve standard. This is the peak, the moment of maximum power. For Portugal, this happened in the early 1500s, when European and Asian merchants officially recognized the real as the primary currency for international transactions. For the Dutch, it happened in the mid-1600s, when the guilder became the currency of international contracts. Even the British East India Company used guilders for transactions because Amsterdam's financial markets were the most liquid in the world. For Britain, it happened at the Congress of Vienna in 1815. After the Napoleonic Wars, the pound was explicitly recognized as the global standard. International treaties, loans, and trade contracts were denominated in pounds. To the United States, it happened at Bretton Woods in 1944. 44 nations met in New Hampshire and formally agreed to make the dollar the world's reserve currency. Other currencies would peg to the dollar. The dollar would peg to gold at $35 per ounce. The IMF and World Bank were created to manage this system. It was the most explicit formalization of reserve status in history. But here's what nobody tells you about Stage 3. This is as good as it gets, because formalizing reserve status creates the seeds of its own destruction. Once you're the reserve currency, the world needs your currency more than they need your goods, so you stop producing goods, you start importing. The trade surplus reverses into a deficit, and the deficit becomes permanent. This is called the Triffin dilemma, named after economist Robert Triffin, who explained it in 1960. For the world to have enough dollars to use as reserves and for trade, the U.S. must run trade deficits. The U.S. must send dollars abroad. But running endless deficits undermines the value of the currency.
You can't be both the world's reserve currency and maintain a strong trade balance. It's mathematically impossible. So every reserve currency, once it reaches stage 3, begins sliding toward stage 4. Deficit spending and living beyond means. This is where the pattern becomes irreversible. The reserve currency stops producing wealth and starts consuming it. Portugal saw this in the mid-1500s. The trade surplus disappeared. Instead of exporting goods, Portugal was importing everything: grain, textiles, manufactured goods from across Europe. They paid for it with gold and silver from Brazil, but they weren't producing wealth anymore. They were spending wealth accumulated earlier. The Portuguese crown spending exploded. King John III spent lavishly on palaces, churches, and the royal court. And here's the key: they didn't notice the problem because the money kept flowing. As long as Brazilian gold kept arriving, they could keep spending. But the gold
Wasn't infinite, and they weren't building anything productive with it. The Dutch in the 1700s followed the same trajectory. After a century of trade surpluses, the Dutch became net importers. Amsterdam's wealth made its citizens comfortable. Why work in factories when you can live off accumulated capital? Dutch investment shifted from trade and production to finance. They became bankers to Europe, lending to other nations instead of producing goods. This generates returns, but it's passive income, not productive growth. Britain in the early 1900s faced the same reversal. By 1900, Britain was running trade deficits. They imported food, raw materials, and increasingly manufactured goods. They paid for this with returns on overseas investments, centuries of accumulated wealth invested in railroads, mines, and enterprises across the empire. The investment income was enormous, but it was extracting wealth created elsewhere, not creating new wealth at home. British manufacturing declined. Factories that had led the Industrial Revolution were closing or falling behind American and German competitors. The United States entered Stage 4 in 1971. That's when the trade surplus permanently reversed into a deficit. By the 1980s, the deficit was growing rapidly. By the 2000s, the U.S. was running the largest trade deficit in history, over $800 billion annually. The U.S. imports far more than it exports: consumer goods, electronics, automobiles, textiles, everything from abroad. How is this financed? By exporting dollars, printing currency and exchanging it for real goods. This works only because the dollar is the reserve currency. Other nations need dollars for reserves and trade, so they accept them. But this is living beyond your means, consuming more than you produce. And it's the same pattern that preceded the collapse of every previous reserve currency. Stage 5. Currency debasement. When deficits become unsustainable, when you can't borrow enough to finance spending, you debase the currency. You print money. Portugal did this in the 1550s. Facing deficits and declining trade revenues, the Portuguese crown began debasing the real. They reduced the silver content in coins and issued more currency than they had metal to back it. This caused inflation. Prices rose. Merchants began refusing reales or demanding more of them for goods. By the 1570s, the real was losing credibility. The Dutch did this in the 1700s. The guilder had been backed by a strong banking system and conservative monetary policy, but by the mid-1700s, the Dutch government was borrowing heavily to finance wars and maintain their colonial empire. When borrowing became too expensive, they began inflating the currency, printing money to cover deficits. The guilder's value declined. By the 1780s, it was no longer the preferred currency for international trade. Britain debased the pound through 2 world wars. World War I forced Britain to print money and abandon the gold standard temporarily. World War II forced them off gold permanently. By 1945, the pound was floating and losing value. Britain printed money to rebuild and fund the welfare state. The pound devalued repeatedly in 1949 and 1967. Each devaluation eroded international confidence. The United States entered Stage 5 in 2008.
The financial crisis forced the Federal Reserve to print money on a scale never seen before. Quantitative easing, $3.5 trillion created from 2008 to 2014. Then COVID hit, $7 trillion more dollars printed from 2020 to 2022. The money supply expanded faster than at any time in American history outside of wartime. This is currency debasement, not by reducing metal content in coins, but by expanding the supply of fiat currency. And the effect is the same. The dollar's purchasing power declines. Inflation surged in 2021 and 2022 to levels not seen in 40 years. The difference between the US and previous reserve currencies is scale. The dollar is global. When the Fed prints, it exports inflation to the entire world. Other nations watch their dollar reserves lose value. This stage is where confidence begins to crack, and once confidence goes, stage 6 follows quickly. Stage 6, loss of confidence. This is when the world starts looking for exits, when trust in the reserve currency erodes and nations begin shifting reserves to alternatives. Portugal lost confidence in the 1570s and 1580s. International merchants began demanding payment in Spanish silver instead of Portuguese reales. Asian merchants who had accepted reales for decades started refusing them or demanding larger quantities to account for debasement. By 1580, when Spain annexed Portugal, the real was already functionally dead as a reserve currency. The Dutch guilder lost confidence through the 1700s. The French, British, and other European powers began holding more of their reserves in other currencies. By the 1780s, Amsterdam was no longer the financial center of Europe. London had taken that position. The British pound lost confidence rapidly after World War II. In 1945, Britain owed enormous war debts. In 1949, Britain devalued the pound by 30%. International holders of pounds lost almost a third of their value overnight. Confidence collapsed. Nations began shifting reserves from pounds to dollars. By 1960, the pound's share of global reserves had fallen from over 60% in 1945 to less than 20%. The transition from pound to dollar was complete within 15 years. The US dollar is in the early stages of stage 6 right now. The signs are everywhere. China and Russia began reducing dollar reserves in the 2010s. They've been buying gold instead, thousands of tons. China's official gold reserves have more than doubled since 2008. Russia liquidated nearly all its U.S. Treasury holdings after 2014 sanctions. The BRICS nations, Brazil, Russia, India, China, South Africa, have been discussing alternatives to the dollar for trade. In 2023, they announced plans for a BRICS currency. It hasn't launched yet, but the fact that it's being discussed is significant. Saudi Arabia, which has priced oil in dollars since 1974, the foundation of the petrodollar system, began accepting yuan for oil sales to China in 2023. This breaks a 50-year precedent. Central banks globally are diversifying reserves. The dollar's share of global reserves has fallen from 72% in 2000 to 58% in 2024. That's a 14 percentage point decline. It sounds small, but it represents trillions of dollars shifted out of dollar assets. Even small nations are reducing dollar exposure. Thailand, Malaysia, Indonesia, they're negotiating trade agreements that settle in local currencies instead of dollars. This is the beginning of stage 6, the world searching for alternatives. Not because they hate America, but because they see the same pattern that destroyed every previous reserve currency. Endless deficits, currency debasement, loss of purchasing power. They're not waiting for stage 7, they're positioning now. Stage 6, replacement. This is when a new currency rises to replace the old, not through formal agreement but through market adoption. The world simply stops using the old currency and starts using the new. The Portuguese real was replaced by the Spanish silver peso in the late 1500s. Spain had conquered vast silver mines in the Americas, Potosi in Bolivia, Zacatecas in Mexico. These mines produced more silver than the rest of the world combined. Spanish silver coins became the preferred currency for international trade because they were abundant, standardized, and backed by ongoing production. The real, debased and declining, couldn't compete. The transition happened over 2 decades. The Dutch guilder was replaced by the British pound in the late 1700s and early 1800s. Britain's Industrial Revolution and naval dominance made the pound the obvious successor. London's financial markets became deeper and more liquid than Amsterdam's. The transition took about 30 years. The British pound was replaced by the US dollar from 1945 to 1960. The transition was formalized at Bretton Woods but took years to complete. Britain was bankrupt after World War II. The US held most of the world's gold and had the only intact industrial base. The dollar was the only currency that could serve as a global standard. So, what replaces the dollar? That's the question everyone's asking, and the answer isn't clear yet because we're not at stage 7. We're in stage 6, the search for alternatives. But history gives us clues. The replacement currency comes from the nation with military dominance over trade routes, a trade surplus, and productive capacity. Right now, that's not any single nation. China has the trade surplus and production, but it doesn't control global trade routes militarily. The yuan isn't freely convertible. China's capital controls prevent it from being a true reserve currency. The euro is the second most held reserve currency, but Europe has deep structural problems: aging population, no unified fiscal policy, dependence on external energy. Gold is increasing in appeal. Central banks are buying more gold than at any time since the 1970s, but gold can't scale to handle trillions in daily transactions. The most likely scenario is a messy transition, a period of multipolar currency competition. Several regional currencies used in different trade blocs: the dollar in the Americas, the euro in Europe, the yuan in Asia, gold for settlement between blocs. This wouldn't be clean. It would be volatile, unstable, and economically painful, but it's how transitions happen when there's no clear successor. The timeline that should concern you. Let me show you something critical: the timeline. The Portuguese real lasted 80 years as the reserve currency, 1450 to 1530. The Dutch guilder lasted 80 years, 1640 to 1720. The British pound lasted 105 years, 1815 to 1920. Each currency lasted roughly 80 to 110 years. The US dollar achieved reserve status in 1944. That's 81 years ago. We're at the average lifespan, and we're exhibiting every symptom of late-stage decline: massive deficits, currency debasement, loss of confidence, search for alternatives. The pattern says what comes next: stage 7, replacement. But here's what's different this time, and this is genuinely different. Every previous reserve currency collapse was regional. When the real collapsed, it affected Portugal and its trading partners. When the guilder collapsed, it affected Amsterdam and Northern Europe. When the pound collapsed, it affected Britain and the Commonwealth. But when the dollar loses reserve status, there's no part of the global economy that isn't affected. The dollar is embedded in every economy, every central bank, every trade transaction. Oil, gold, wheat, all priced in dollars. There's over $70 trillion in dollar-denominated bonds alone globally. A dollar collapse triggers defaults across every continent. Emerging markets that borrowed in dollars won't be able to repay. Corporations that issued dollar bonds will face bankruptcy. Even developed nations will see their central bank balance sheets implode. The systemic risk is orders of magnitude larger than any previous transition. This isn't just a currency transition, it's a restructuring of the entire global financial system, and restructurings are never smooth. They're painful, chaotic, and destructive to existing wealth. What this means for you. When reserve currencies collapse, it doesn't just affect governments, it destroys ordinary people's savings and wealth. Portugal's collapse caused economic depression across the empire. Merchants who held reales saw their wealth evaporate. The Dutch collapse devastated Amsterdam's middle class. Savings held in guilders lost value. Britain's collapse after World War II impoverished a generation. British citizens who held pounds, government bonds, and pensions denominated in pounds all lost purchasing power as the currency devalued repeatedly. And the American collapse? It's happening in slow motion. Every dollar you hold is losing purchasing power. Since 2020, the dollar has lost roughly 25% of its value through inflation. Your savings, your paycheck, your retirement account, if it's denominated in dollars, it buys 25% less.
And this is just the beginning of stage 6. If the pattern holds, if the dollar follows the same trajectory as every previous reserve currency, the next decade will see accelerating decline. More inflation, more loss of purchasing power, more nations dumping dollars. And when stage 7 arrives, when the replacement happens, there will be a moment of collapse, a currency crisis. The dollar could lose 50% of its value in a matter of months. This happened to the pound in 1949. It can happen to the dollar. What you can do. First, understand that holding only dollars is a risk, not a safe haven. Diversify out of pure dollar exposure. This doesn't mean abandon dollars entirely. You need dollars to live if you're in the US, but don't hold all your wealth in dollars. Hold assets that preserve value across currencies: real estate, productive businesses, commodities. These hold value regardless of what currency is used. Second, watch the indicators of stage 6. Watch central bank reserve data. If you see accelerating declines in dollar reserves, that's confirmation the transition is speeding up. Watch trade agreements. If major nations start settling trade in other currencies, that's a sign. Watch gold prices. If gold surges, it means the world is fleeing fiat currencies. Third, understand that this isn't about politics. It's not about whether you like or dislike American policy, it's mathematics. The same mathematics that destroyed the real, the guilder, and the pound. Every reserve currency follows the same 7 stages, and the dollar is in stage 5, moving into stage 6. The pattern doesn't care about exceptionalism. It doesn't care about military power or economic size. It cares about deficits, debt, and debasement. And on those metrics, the US is following the script perfectly. Closing. The reserve currency death pattern isn't a conspiracy. It's a historical cycle documented across 6 centuries, 7 stages, 4 currencies, and now a 5th. The only question is whether you will see it before it completes, or whether you'll be caught holding a currency that's collapsing while smart money has already moved to assets that maintain value. The pattern is clear. The timeline is evident. The dollar is in stage 5, and history says stage 6 and 7 follow, not as possibilities, but as probabilities. This is how reserve currencies die, not with invasion or catastrophe, but with mathematics. Slow then fast, ignored then undeniable. And by the time everyone sees it, the transition is complete.